So, you think you're playing the market, right? You're buying some stocks, maybe dabbling in crypto, just hoping it grows. But what if the game isn't exactly what it seems? What if there's someone out there who's always one step ahead, using that advantage to basically clean you out?
Look, it's a fear we all have. You hear these stories, the flashy Wall Street gurus promising you the moon, and then poof, it all comes crashing down. And it's always the regular folks left holding the empty bag. It really makes you wonder, is there something happening behind the scenes that I'm just not seeing?
Well, here's the good news. Most of these scams, they're not nearly as clever or as random as you might think. Today, we're going to pull back the curtain and break down the simple, universal pattern behind pretty much every major market scheme. Once you see it, you'll be able to spot the red flags a mile away. Okay, let's get into it.
What's absolutely fascinating is that it doesn't matter if we're talking about a shady boiler room from the 90s or some high-tech crypto scam today. They almost all follow the exact same predictable blueprint. And once you learn this pattern, you are going to start seeing it everywhere.
It all kicks off with hype. You see, the insiders create this irresistible story, this can't-miss shortcut to wealth. That excitement, that's the bait. And once you're hooked, they pivot to step 2, control. Maybe they secretly own almost all of the stock, or they manipulate the news so you only hear good things. This whips up a buying frenzy. And that, of course, leads to the final, absolutely brutal step, the sell-off. The insiders dump all their shares at the very peak, the price completely collapses, and yep, everyone else is left holding the bag.
All right, so let's see this playbook in action. Our first case file is the pump and dump. This is the absolute classic, the original gangster of market fraud. And believe me, it is still happening every single day. And nobody perfected it quite like Jordan Belfort. First, he established control. His team would use secret buyers to quietly gobble up huge chunks of some tiny unknown company's stock. Then came the hype. His brokers would get on the phones and just relentlessly push this stock as the next big thing. And as people rushed to buy in, the price would soar, which perfectly set up the sell-off. Belfort and his crew dumped everything, making an absolute fortune as the stock crashed to practically zero.
You know what's wild? It's how little the game has actually changed. I mean, sure, the tools are different now. That pushy phone call has been replaced by an anonymous message in a Discord chat. But the playbook? It's identical. Control the supply, create a ton of artificial hype, and then dump on all the unsuspecting newcomers. It's the same scam, just with a new coat of paint.
Okay, let's open our next case file. This one's a little more subtle, but trust me, it's just as damaging. We're talking about insider trading. It's all about having an unfair advantage. Honestly, it's like getting the answers to a test a week before anybody else. You are guaranteed to win. And this case is a textbook example. Back in the 80s, an investor named Ivan Boesky got a secret tip. You can see it right here in the table. Before any public news, with the stock sitting around $65, he starts buying millions of shares. Why? He knew Nestlé was about to buy Carnation. The second that merger was announced, the stock shot past $80. The result? Boesky sells his shares for a cool $28 million profit. See, he didn't control the supply this time, he controlled the information.
And this whole idea of an insider's edge is still incredibly powerful today. It's actually led to this weird trend called the Pelosi tracker, where everyday investors try to copy the publicly reported trades of prominent politicians. The logic, right or wrong, is that these lawmakers might have a heads up on future policies that could send certain stocks flying.
But here's the massive catch. These trades are often reported days, sometimes even weeks, after they actually happen. So by the time you hear about it, that big price jump might have already come and gone. You think you're getting an insider's edge, but really, you might just be buying in right at the top. All right, on to our final and by far most complex case, because sometimes the scam isn't just one person or one company. Sometimes it's the entire system. This is the story of the 2008 financial crisis, which is really about how Wall Street turned the entire housing market into a giant, high-stakes casino. It all started with this incredibly complex thing called a CDO. Now, the basic idea was to take thousands of individual home loans, some from people with perfect credit, and a whole bunch that were super risky, and just bundle them all together into one giant financial sausage. Then they'd slice up this package and sell it to investors all over the world who were told they were buying a safe, diversified asset.
Oh, but they didn't stop there. Wall Street then invented something called a credit default swap, or a CDS. It was sold as insurance on these CDOs. But what it really was a way for people to place massive bets that those homeowners would default on their mortgages. Think of it like buying fire insurance on your neighbor's house and then secretly hoping it burns to the ground.
So let's just trace this toxic journey, okay? A homeowner gets a really risky loan. The bank, wanting no part of that risk, immediately sells the loan to a Wall Street firm. Then Wall Street bundles it into a CDO. And here comes the hype. They get a rating agency to slap a safe AAA rating on it, even though it was filled with junk. And then comes the sell-off. They sell this supposedly safe investment to, say, a pension fund, who has absolutely no clue they just bought a ticking time bomb of bad debt. The risk just got passed down the line.
And this is where it just goes completely off the rails. A firm like AIG didn't just sell one insurance policy on a loan. No. They might sell 10 policies to 10 different people, all betting against the exact same asset. Now, if the homeowner paid their mortgage, great. AIG collected 10 sets of fees. But if that one loan failed, they owed 10 times the payout. It was a massive gamble built on a mountain of completely hidden risk.
Okay, so after seeing how all these scams work, from the simple to the systemic, the most important question is, what do you do about it? How do you actually protect yourself and spot these traps before you fall into one? Let's break down a simple defensive game plan.
First off, diversify. Seriously, don't put all your eggs in one basket, especially if that basket is some hot meme coin or a penny stock someone's hyping online. That way, if one of them turns out to be a scam, it doesn't wipe you out completely. Second, question those sudden, insane price spikes. If a stock is shooting for the moon and you can't find any real news or a solid reason why, that is a massive red flag. And finally, just be skeptical. The promise of easy, guaranteed money has been the bait in almost every scam in history. If getting rich was that simple, they wouldn't need your money to do it.
And, maybe the best piece of advice comes from the man himself, Warren Buffett. By understanding the mistakes that other people made, by seeing how people got trapped in these schemes, you give yourself the best possible chance of not becoming one of them.
So, there it is. The playbook is surprisingly simple, right? Hype, control, and sell off. It doesn't matter if it's a slick broker, a secret insider, or an entire financial system built on bad promises. The game is the same. So now that you know how it's played, the real question is, what red flags are you going to be watching out for?